Hey everyone, and welcome to This Explainer. I am absolutely thrilled to have you here today. We're going to tackle a topic that completely dominates the headlines, dictates global government policies, and directly impacts literally every single dollar in your bank account right now: inflation. But listen, we aren't just going to focus on the doom and gloom you usually hear about. We're unpacking inflation as a really complex, two-sided force. Because yeah, it can be a heavy tax on your savings, but surprisingly, it also creates massive opportunities and some very distinct winners. By the time we wrap up, I promise you're going to see the economy in a completely different light.
Okay, let's dive into this. Here is our roadmap for today. First, we'll cover the basics of price increases. Second, how inflation actually shrinks your wallet. Third, we'll look at the surprising winners. Fourth, what happens when prices spiral totally out of control. And finally, inflation's direct impact on your investments.
So I want to start by throwing a pretty provocative question your way. Is inflation actually secretly making you richer? Now, I know exactly what you're thinking. Every time you fill up your gas tank or hit the grocery store, you just feel poorer, right? The everyday assumption is that rising prices are always, 100% of the time, a bad thing for everybody. But as we're going to discover today, depending on where your money is parked and exactly how your debt is structured, that conventional wisdom might actually be wrong.
Let's jump right into Section 1, Basics of Price Increases, or Understanding the Engine.
Before we can even talk about winners and losers, we have to establish what this economic engine actually is on a macro level. 2.4%. That was the U.S. inflation rate as of October 2024. Now, context is literally everything here. Is 2.4% good? Is it bad? Well, the Federal Reserve, the central bank of the United States, actually has a long-term target of 2%. They actively want prices to go up just a tiny bit every single year. So 2.4% means we're sitting just slightly above that ideal, carefully managed target. But what actually drives that number up in the first place?
Well, there are basically three main triggers of rapid price increases. First up is an imbalance in supply and demand. Simply put, if consumer demand spikes, but the supply of goods just stays flat, prices are going to go up. Second, we have supply shocks. A perfect recent example of this was Russia's invasion of Ukraine. Russia cut off global energy supplies, which severely tightened the market, and everyday energy costs for consumers absolutely skyrocketed. And third, just the mere expectation of inflation. Seriously, if people think things will be more expensive tomorrow, they start demanding higher wages today. Then, businesses raise their prices to cover those new wages. It essentially becomes this self-fulfilling prophecy.
Which brings us to Section 2, How Inflation Shrinks Your Wallet. The Squeeze.
This is where we look at the immediate negative impacts and how everyday consumers actually feel the pain of those macro triggers we just went over. Look, if you only take one single thing away from this explainer, please let it be this concept: purchasing power. This is the absolute core of our entire discussion. Purchasing power dictates exactly how far your money actually goes. When inflation hits, a fixed amount of money buys progressively less and less stuff. Whether inflation is at a mild 2% or a painful 4%, you are actively losing purchasing power. You just lose it faster when the rate is higher. Your $100 bill remains a $100 bill, but the actual basket of groceries it can buy just shrinks right before your very eyes.
But here is where it gets deeply, deeply unequal. Lower-income households bear the absolute heaviest burden here. Why is that? Because they spend a much larger proportion of their household budget on necessities that are really hard to just swap out or ignore, specifically food and energy. Now, policymakers often like to point to something called core inflation, which actually omits food and energy prices entirely because they're quote-unquote too volatile. But omitting them completely masks the disproportionate harsh reality for lower-income households. And to make matters worse, lower-income individuals rarely own assets like real estate, which traditionally act as a strong hedge to protect against inflation.
Moving on to Section 3, The Surprising Winners of Inflation. The Silver Lining.
Okay, so we've seen the squeeze, but who actually benefits from a devalued currency? Because yes, there are totally winners here. Let's compare the winners and losers. The big winners? People holding fixed-rate mortgages. The losers? Anyone stuck with adjustable-rate mortgages and credit card debt. Let's say you borrow money for a house at a locked-in, fixed 5% interest rate. If inflation suddenly spikes up to 10%, the real inflation-adjusted value of your loan balance is actually dropping way faster than the interest is accumulating. You are effectively paying the bank back with inflated, much less valuable money. It is a massive financial win for you. But on the flip side, if you have an adjustable rate mortgage or high credit card balances,
Banks are just going to hike your interest rates to keep pace with inflation, and in that scenario, you get absolutely crushed.
There's actually another big winner when it comes to mild inflation: the broader economy itself. A little inflation prevents deflation. Now, deflation, which is a widespread drop in prices, might sound super great at the checkout counter, but it is catastrophic for an economy. Think about it. If you know a car is going to be cheaper next month, you're going to stop spending today. When everyone stops spending, incomes decline, businesses start laying people off, and widespread loan defaults can literally trigger a banking crisis. Modest inflation essentially greases the wheels of commerce. It encourages you to spend and invest your money right now, rather than just hoarding it under your mattress.
Let's get into Section 4, when prices spiral out of control, the danger zone.
So we know a little inflation greases the wheels, right? But let's look at how this builds into a total economic catastrophe when it's left unchecked by central banks and policymakers. Walk through this dangerous cycle with me. This is known as the infamous wage price spiral. Step 1, prices increase rapidly. Step 2, because everyday life is now so incredibly expensive, workers demand larger wage hikes from their employers just to survive. Step 3, employers agree, but to cover those massive new labor costs, they have to raise the prices of their products. Step 4, the whole cycle just repeats. Prices go up again, so workers demand more money again. It aggressively feeds on itself, completely independent of whatever caused the inflation in the first place.
And if you want a real-world cautionary tale of this spiral in action, you don't have to look any further than the US in the 1970s and 80s. The 1970s was a brutal decade of stagflation, which is stagnant growth combined with sky-high inflation. By 1980, inflation had topped 13%. To break this terrifying cycle, the Federal Reserve had to administer a really brutal cure. By 1981, they hiked the federal funds interest rate to over 20%. That severely constrained the money supply and finally halted the inflation. But wow, the medicine was incredibly painful. Because borrowing became so impossibly expensive, businesses contracted, and unemployment still topped a devastating 10% as late as mid-1983.
But honestly, even the 1980s look like a walk in the park compared to this next jaw-dropping number: 1.5 trillion. This is the extreme, absolute worst-case scenario. This represents the level of hyperinflation in Weimar Germany by December 1923 compared to its pre-World War I measure. The cost of living increased 1.5 trillion times over. Let that sink in. A currency can become entirely, completely worthless if an inflationary spiral is mismanaged by a government.
Finally, Section 5, inflation's impact on your investments, protecting your wallet.
So, the big question: how do we survive this invisible tax? Let's get into some highly actionable, real-world takeaways. When inflation runs hot, not all assets are created equal. Let's break it down. Some assets really struggle. Bonds take a huge hit, for example. Why? Because bonds pay a fixed interest rate. If inflation spikes, the present value of that future fixed income drops significantly. Growth stocks, particularly in the tech sector, also tend to suffer because inflation heavily discounts their future cash flows. But then you have your protective shields. Things like real estate, energy commodities, and value stocks historically act as fantastic hedges. They tend to hold their value or even rise right alongside consumer prices.
To really cement this idea, let's look at a direct quote from our source material. Real estate has historically served as a hedge against inflation because landlords can protect themselves by raising rents even as inflation erodes the real cost of fixed-rate mortgages. It is literally the ultimate double win. Your asset produces more income because you can charge higher rent, while simultaneously the debt you owe on the property is becoming way cheaper to pay off in real terms. This is exactly why hard assets are considered a traditional safe haven.
Wow, okay, we have covered a ton of ground today, right from the macro forces of supply and demand all the way to the very real impact on your mortgage and your investment portfolio. I want to leave you with this final, vital question to ask yourself today. Are your savings keeping pace, or is your purchasing power quietly fading away? Take a hard look at where your money is sitting, evaluate your fixed versus adjustable debts, and just make sure you are positioned on the winning side of this incredible economic force. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.